You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, MEQ.TO. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Monday. This time, we are taking a look at, I would say, an unconventional stock to my liking, like not something that would pop up on my radar, but that was brought to my attention by one of my Dividend Stocks Rock member a few months ago, and did the complete overview during a private webinar, and I thought of maybe I could share this with some moose, right? So Mainstreet Equity, MEQ.TO, flying high. Strong dividend triangle. Besides the fact it's a new dividend payer, so they just started to pay a dividend in 2024. They increased it for 2025, but the yield is ridiculous. We're at 0.08%. So nothing interesting here. Not even double. That's nothing, right? They just started to pay. Small market cap, 1.7 billion. So I would say it's a small cap, but it is doing incredibly well. So over the past 3 years, it's pretty much aligned with the S&P TSX 60. So 53% total return, the TSX at 60%. But if you look at 5 year, then 5-year return is 185 versus 98%. And then for the past 10 years, 425% total return versus the TSX at 160. So definitely kind of interesting from a returns point of view. Then when you look at the dividend triangle, that's also interesting because you see that the revenues are increasing in a very stable way, which is really good. So it kind of piqued my interest to see what was under the hood a little bit more. So Mainstreet Equity, you don't have that much information around. So it's not exactly your typical REIT in a sense where it is a REIT, they're buying mid-market apartment buildings, but their playbook is really to get into older rental properties in urban centers such as Calgary, Edmonton, Saskatoon, and Surrey, BC. What makes Mainstreet stand out as it's a unit counter-cyclical model is they buy those under-managed, undervalued apartment buildings. They renovate them, raise their rents, and boost occupancy. So I kind of like Intrent REIT. I like the business model. I don't have it in my portfolio, but what I like about them is they focus on kind of the high-end apartment REITs, apartment buildings. In case of Mainstreet, they just select the mid-market. So they don't go too fancy, they don't go too expensive. And I guess that it's a model that works well because most of the time those properties are overlooked assets. So it's kind of an interesting niche, especially in Western Canada where you have a lot of economic growth, so a lot of people may find that those high, expensive apartments are way too much for their taste, so they could go mid-market in brand new, renovated property. So that's what Mainstreet is doing. So that was the playbook. The growth vectors, well, of course, because they focus on that niche, it's a little bit easier for them to find good deals. Most of the time, big institutional players will focus on those new shining buildings. So Mainstreet is thriving in this overlooked property market. That's the first thing. The second thing is, as I mentioned earlier, Western Canada rental demand is booming. The population is growing. They're making money. There's higher immigration, tight supply. So a lot of things that makes it favorable for urban rentals in the mid-market. And finally, they are also very aggressive in refinancing. So they use as much leverage as possible to keep the business growing and to fuel their growth moving forward. In terms of economic moat, well, do they really have a competitive advantage? I mean, besides the fact that they focus on a niche kind of like business model. They have this expertise, but I don't know. I find that it's a bit getting a little bit far from what is a real moat, a real protection against competitors. Because I mean, honestly, any other real estate property management team could decide to go into this market and compete with them. It's not something, it requires not more like capital or anything else. So a little bit of expertise. I mean, you can buy talent everywhere, right? So I would not consider that they have a strong economic moat. So they do have like good tailwinds, but not necessarily something that will protect against competition. In terms of potential risk, well, they're heavily exposed to Alberta and Saskatchewan, so just two provinces. You know, when especially in REITs, if the economy fails, like just thinking about natural resources and energy, if it goes down, well, those two provinces will be hit more than others. As similar to like tariff could affect a lot more Ontario and Quebec. Well, if the energy sector goes down, well, the entire economy of Alberta is going to slow down as well, and that could hurt. Of course, they are exposed to interest rate change. As you know, I just mentioned they're like using a lot of leverage. So if like interest rate goes higher up, which is kind of not the case, like not the case in 2025, but going forward, that could be also another problem. And the other thing is that in terms of dividend perspective, it's really hard to know where it's going to go. Just like not even two complete years of dividend growth history. Yes, there was one increase, but it's not that much in my opinion, especially considering the yield. Those are the reason why I would probably like sit here. I'm not overly excited by the model. First, it's a REIT, so not necessarily focus on super growth. The good days were a little bit like further away. So the 5 years and the 10 years return show that the good money was made a while ago. If you look at the performance over the past 1, 2, and 3 years, not so much exciting. So with an ultra low yield, I would have expected more growth. So to kind of compensate for the fact that you offer a very low yield, you need to offer like double-digit growth, right? So if I look at a company like Dollarama, for example, I don't really mind the ultra low yield because I have ultra high growth, which is like double-digit revenue growth, double-digit earnings growth, and double-digit dividend growth. I'm not getting this with Mainstreet. On top of that, it's a REIT. On top of that, it's a small cap. So for those reasons, I don't think it deserves a place in my portfolio. However, I mean, I'm just one person with one angle, so I'm going to let you do your due diligence. I just wanted to highlight this one because I don't think we talk about Mainstreet Equity at any time, right? So that was one to put on your list to like having another idea and take a look at it. So on Wednesday, I'm going to discuss another stock that is not performing well these days, Hang House. I want you to subscribe to the Moose and Loose to make sure to not miss it. And if you're looking for more solid picks, I suggest that you download my Rockstar list. So the Rockstar list can be found at moosemarkets.com/rockstar. And when you go there, you can subscribe to my newsletter, download the list, and every month you're going to get an updated list. This list shows all Canadian and US stocks showing a positive dividend triangle. So companies with steady revenue growth, steady earnings per share growth, and of course, steady dividend growth. So when you have those three, that makes it a very strong dividend triangle. So it makes a great list to take a look at and pick among the best driving companies. All right, Moose, that's enough for today. We're going to talk again on Wednesday. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.